Okay, welcome to the lecture entitled Don't Short the Shorts. Now that's a peculiar title and it definitely deserves an explanation. Well, the word short there is in reference to short selling. Now that's a concept that some people have probably heard of, many people have probably heard of, but are not really familiar with. They're more familiar with going long on a stock, right? And of course that's the opposite. Well, what does going long on a stock mean? Well, it means what most investors think it means, which is you buy a stock now with the hope that in weeks down the road or months down the road or perhaps years, the price of the stock will rise, and at a later date, when it hits a price that you're comfortable with, you're able to enjoy a nice, handsome profit. Now, that's what most of us do. However, that's when we're bullish on the stock. That is, we believe the price of the stock will rise because we have faith that the company's earnings and profitability will go up. But what if you have a different outlook for a company? Well, there isn't any avenue to sort of communicate your preferences, right? Except for the fact that there is this process known as short selling. So what is that? Well, unlike going long where you buy low and you sell high, shorting a stock is the exact opposite. You sell high and you buy low. Now I know that sounds peculiar because if you sell something, then what do? Buy it back? Well, yeah, that's exactly what you do, but there's a little catch here. What really happens is, first of all, this is done through a brokerage firm. You open up what is called a margin account. I don't want to get into all the real nitty-gritty details of it, but a margin account is an account where you can borrow money from a brokerage firm, or you can borrow stock from a brokerage firm, ostensibly for the purpose of shorting that stock. So how does that work? Well, it turns out that some people, when they invest money in stocks at a brokerage firm, are willing to lend out some of their shares to other members at that brokerage firm, other clients, who then may wish to short that stock. And they want to make sure that their stock is performing something useful. They receive a payment, of course, when their stock is being borrowed, and so there's an attractive element for them there. But let's assume that we're looking at Google. And let's say that Google's current price is $150 per share, and that you're interested in shorting 100 shares. Okay, so what would happen? Well, you ask your broker if there's 100 shares available anyway in the first place, because not all the time are shares available for particular stocks for you to borrow. So that's kind of actually is the first hard part. If the brokerage firm gives you the green light and say, yeah, they're available, great, then you buy them. You borrow them. And how much is the value, the capitalization of them? Well, it's 150 times 100, which is $15,000. That's the value of all these shares. What do you do now? Well, what you do now is you immediately sell them for $15,000, and you pocket that cash and you put it in the account at the brokerage firm. In fact, you're required to keep it in the account. You can't literally pocket it. You don't receive a check or anything. It stays in that margin account. And then what happens is, remember, you're the guy that thinks that the price of the stock is going to go down. Maybe because you believe that Google is going to not fare well because of change in economic events, may be brought about by bad economic news in the next quarter. And other people don't see it like you see it. And in fact, you think it's going to fall, not dramatically, but enough to be able to make a handsome profit. And let's say that you have to return these shares in 3 months. And within 2 months, the price has already fallen to $145 per share. Okay, fine. So what do you do now? Well, maybe you don't want to wait any longer. You want to instantaneously but try to make some profit. So what do? You go into the open market and you buy up those 100 shares that you have to give back to the person that lent them to you, right? So how much is that going to be? 145 times 100, and that's 14,500. Now that looks a little bit silly, right? What are you doing? You just sold those shares and now you're buying them back. Remember, you have to buy them back because you have to give them back because you borrowed them. But do you see a differential here? Look at that. You collected $15,000, but you only had to pay $14,500 for the stock, which meant that your profit, whoop, I don't know why I put a comma there, but your profit is a nice $500, right? That's how much you make on that deal, less fees for borrowing the stock and the execution on the trade, right? Which is not going to be a sizable chunk. So you've made a nice profit for a day's work, right? Now, often this activity is found to be nefarious by the rest of the investing public. In fact, politicians are probably the most famous, or what I would refer to as infamous, for calling them un-American. This is unfair. Companies shouldn't have their stocks shorted. It's almost like the antithesis of a cheerleader. Instead of the cheerleader rooting for the home team, the cheerleaders are yelling out and booing, the team. But that's not really what's happening. What's really happening is that the short sellers are communicating useful information to the public by saying, look, we lack confidence in this stock. We think the price is inflated, and we're going to prove it to you. In fact, we're going to put some skin in the game. It's not like sending out some newsletter by email, which anybody can do, and you've probably seen your inbox and your email account flooded with all sorts of unsolicited advice about which stocks you should buy and which ones you should sell. That's easy to do that. All you have to do is click the send button. But it's a lot harder to really put your neck on the line and put some cash on the line, right? Because these people have skin in the game. And in fact, short selling positions are actually made public. So the rest of the public actually knows about them. And that might be useful. Now, you're trying to make money. That's certainly true. It's not like you're being necessarily ostensibly patriotic or rah, rah, rah for the firm. In fact, you're thinking different thoughts, right? But the rest of the public may actually benefit from this, because if the rest of the public starts to get a little squeamish because they see the amount of short positions rising, they may say to themselves, man, maybe Google stock's not a good value at 150. They're not saying Google in general is not a good company to invest in. They're just saying at the current strike price, the current market price, it may not be a good value. And so that might kind of put a little damper on demand. Now, of course, it's not going to damper demand for everybody, because not everybody is going to necessarily be swayed by this short selling position. It all depends on, whether there's a movement drifting upward in the percentage of short sellers in that particular firm or in the industry in general. And so savvy investors weigh all of these things, but clearly a useful function is being performed. The same thing is true on the other side. When people go long, when they buy a stock now and hold on to it for weeks or months or maybe even years, they're really saying, I view the prospects of this company to be quite good. And so you're sort of voting with your pocketbook when you buy the shares. And that voting sends a signal to other folks to say, hey, we think Google's a good buy at 150. Let's go ahead and buy. But nobody seems to think, oh, well, gee, that's wrong, because after all, these people are hoping to make a profit. But suddenly, when it's looked at the other way, they say, well, those people are looking to make a profit, but we think that's somehow evil. But I think part of what's wrong with the system, and the reason why short selling is sort of demonized by the investing public and by politicians, is that there's sort of this built-in bias in favor of buying and a built-in bias against selling. And this has a very long history. By the way, short selling goes back 500 years. This isn't time for a history course, but literally short selling began in the 1500s. Nonetheless, for our purposes in the United States, the first time it came under really intense scrutiny was the case of the stock market crash. In fact, there was an endless supply of folks that were arguing it's all those people that went short on the market that caused the market to tumble. And that's actually not really true. It's certainly true that short selling did depress prices, but the percentage of people shorting in the market are in the single digits range, right? And one would have to say, gee, if you're talking about just a small percentage and that percentage didn't change dramatically, short selling couldn't be the only culprit. And it turns out that tales like this die really, really hard because in 2008, same thing. Everybody wanted to blame the financial woes of the bank and the finance sector for the financial crisis on the shorts, those engaged in short selling. And in fact, the SEC went out of its way to pass a rule prohibiting short selling, at least for a temporary period, on about 800 banks and financial institutions. And it did protect them, of course. But did it protect everybody else, right? Were wary investors being given information about which banks and financial institutions were really in not as good a shape as we were led to believe? Well, that information is taken away from you when you don't have short selling. So we really have to be careful about how we craft public policy and knee-jerk reactions that policymakers have when we see bad economic events unfold, right? So in any event, this is short selling in a nutshell. It's not meant to be a comprehensive treatment. If you want to learn more about short selling and the pitfalls of it and of course the rewards of it, you should take a finance course. And we have finance courses available at the college here. But I also wanted to explain one other thing before we go, and that is short selling is not without its risks, right? Because after all, things could have gone much differently for this fellow who shorted these stocks of Google. And that is, what if things had gone the other way around? What if instead of the price plummeting to $145, instead the price right before the 3 months was up, rose to $155 per share? Well, that would be a big problem, because if you're approaching the time when you have to actually turn those shares back over, you're going to have to hurry up and buy them, right? And unwind your position. How much are you going to have to pay? $15,500. And that means what? A $500 loss on your investment. In fact, you could argue that short selling is even more risky than long buying. All right, why is that? Well, let's say that you want to invest in some new high-tech firm that's currently trading at $75 a share. And let's say you really get it wrong and you buy 100 shares. Well, how much is that going to cost you? $7,500. What could happen? You could lose the whole thing. The company could go south, lose tons of money, eventually have to declare bankruptcy, in which case the shares would be absolutely worthless and it would be off of the trading boards. That's catastrophic. But that's the worst of the catastrophe. That's the maximum amount of money you could lose. But when you short a company, you know, the sky's the limit on your losses, because this number can go north ad infinitum, right? Now, of course, not realistically, it's not going to go to, you know, $300, $400 in such a short period of time, but it can go up really, really high, and you can wind up losing a lot of money that way. And so you could argue, yeah, of course, they're gambling. Yes, to some extent that's gambling, but you could argue that it's gambling on the other side when you buy shares of Coca-Cola and hope and a prayer that the price of Coca-Cola will go up. But for some reason, people don't look at that as gambling. They only look at this side as gambling. And what I would argue is both sides of the market are performing a useful function. In fact, the other thing that we can say about short selling is that short selling actually provides liquidity for the market, not just communicating information, which is an important function itself, but liquidity is also the lifeblood of a well-functioning market, the ability to be able to buy and sell shares of a company rather easily. Okay, that's pretty much it for this lecture. I hope you enjoyed it, and until next time.